This is Michael Hiles. I'm CEO of 10XTS, and here today. Thanks for joining this webinar with the esteemed Mr. Butler from Dalmore Group. Glad that everyone can join us. This webinar, we're starting a webinar series around digital securities and the digital securities industry, specifically talking to folks associated with and around the industry to carry on the various discussions about tokenized securities, about digital programmable securities. What does that mean? How does it work? How does it interoperate in the secondary markets? And so this is the first webinar for our community, Digital Securities Lab, dslab.co, and that is a online community for professionals that are interested in this space. If you go to DS Lab, you'll see that there's a paywall, but we will be distributing a link to everybody that registered for this webinar for a VIP invite, so that you can join the community at no cost. We figure if folks are interested enough to sit through a webinar and listen to all of this stuff, and then go out and spend their time signing up for an online community, they're probably good folks that need to be involved, and we're happy to jump people ahead of the velvet rope, so to speak, in the community. It is focused ostensibly on regulatory compliance, monetary policy, digital securities, licensing of the various custodians, trusts, broker-dealers, ATSs, and we've got a lot of interest from the legal community as well. But there are also issuers of securities that are leaning into the space, as well as investors that are starting to take notice of the emergence of the industry. So with that, I'd like to introduce our co-host guest today, Mr. Butler. How about you give a little intro and specifically tell us about your great work at Dalmore Group.
Great. Michael, thank you so much for having me on today. Etan Butler here. I'm the chairman at Dalmore Group. We are a FINRA and SEC registered broker-dealer investment bank headquartered in New York. We were founded in 2005, and we spent the first 10 years or so focused primarily on providing institutional investment banking and corporate advisory services to both private and public companies in multiple sectors. Since the Jobs Act of 2012, we made a shift to helping companies raise capital primarily online at scale through SEC regulations D, regulations A, and regulations CF. And since regulation A kind of became more heavily utilized really towards the end of 2018, early 2019, that's when we got involved in regulation A. And since that time, we've onboarded over, I think, 215 or so regulation A clients, including many of the most successful Reg As that have been done so far. And our services have evolved from, primary issuance related regulatory broker-dealer services, now very focused as well on the secondary market trading of private securities as well. And we're seeing a big uptick in folks that are approaching us with digital ambitions, with various degrees of understanding and vocabulary. But this idea to have an interest in tokenizing their offering, their shares, issuing their shares to the public, and ultimately facilitating the secondary market trading of those securities. And so anyway, that's a pretty long-winded
That's awesome.
intro to us,
great.
But that's what leads us here today.
No, super. I appreciate that. So when you talk about Regulation A, I'm sure there's securities folks in the audience and that are acclimated to the markets. But can you give me a quick sort of just differentiator between, say a Regulation A offering versus, say, like a Reg D private placement? Can we get a little distinction on what that is and how do those work?
Yeah, so these all apply to companies that are looking to raise capital, primarily in the U.S., but also internationally that include U.S. investors, and they have a number of options as far as exemptions to consider. The first is Regulation D, which is probably the most popular, right? You can raise an unlimited amount of money, but you're limited to only being able to raise capital from accredited investors. And I think that's around under 10% of the investor population out there today, and kind of the audience that everyone else is going after as well. So if you're going to be relying on marketing and promotion, Reg D could be a bit challenging because only 10% or so of the folks that hear your messaging could respond and participate. Then there's Regulation A, which is what Dalmore's been really focused on significantly over the last few years. And it's interesting because with Regulation A, an issuer could raise capital up to $75 million a year, right? So there is a limit per the issuing entity, unlike Reg D. But you could raise capital from pretty much anyone over the age of 18, right? In the US, in most international jurisdictions as well. And what's unique about Regulation A is that unlike Regulation D and Regulation CF, both of which have a 1-year seasoning period before an owner of those securities could facilitate the secondary market trading of those securities, Regulation A, there's an immediate path to potential liquidity, right? And so it affords folks in the digital asset space or headspace that are looking to, fractionalize and issue and via blockchain and allow anyone to participate and have an immediate path to potential liquidity. In my opinion, that most closely mirrors that objective, but it's presented in a regulated fashion. So the investors are protected because ultimately there's an SEC approved transfer agent that has the final say on who owns what, right? And so there's KYC and there's AML and there's suitability and all these regulated terms that are introduced to the equation, which is, I think, super healthy to the issuer and to investors. And then there's Regulation CF, which since the previous March 15th, issuers are able, US-based issuing entities are able to raise up to $5 million per year. And what's interesting about Regulation CF is that unlike Regulation A, you don't need to get SEC qualified, which is an expensive process. You're paying attorneys a lot of money, you're waiting a lot of time, you're coming up with a very significant offering circular that you're submitting to the SEC. Regulation CF allows you to only raise up to $5 million, but it's through a notice filing. So oftentimes you could get to market a lot quicker. But again, you don't have that immediate path to potential liquidity. So those are those three exemptions that are typically used for raising capital from the issuers that we encounter.
Absolutely. So, if you're an issuer, say you're a company, early stage company that's tokenizing or just simply raising money, leave token out of it for the moment, but you want to raise money. Ultimately, why is secondary market liquidity important, right? I mean,
because after the allure of someone buying a share in a company once or twice or 3 times, owning a private security, this isn't NASDAQ. You're not logging on to Schwab and looking at bids and asks, right? These are private securities. Like if you and I got together and we both invested 100 grand into a real estate deal, right? It's like, what is liquidity? It's a going public event. It's a distribution to shareholders. This is what, 3 years, 10 years, never going to happen. Maybe, who knows? It depends. So Regulation A and combined with secondary market trading gives a another path to potential liquidity to investors, right? They're able to buy shares of an asset or of a company, but they don't have to wait however period of time, until the company hopefully goes public one day, right? They're able to actually see a bid and an ask for that private security in a similar way that they would see a public security, right? Now, doesn't mean there's going to be anyone on the bid, right? But it at least sets the framework to allow for a bid and ask to be presented along with the participation in the IPO. And we're seeing a lot of that activity on the secondary side in the fractional share issuers. We have about, of the 215 or so Reg A clients, about 25 or so are these fractional share platforms. These are companies, and this isn't a recommendation to buy any of these securities or an endorsement of any of the companies I'll mention, but they're pretty big names, companies like Rally Road and Otis and Collectible. They're in the collectibles space. They're in the or in the real estate space or in the art space, and they're utilizing Regulation A not just to raise up to $75 million for a company. What they're doing is they're setting up series LLCs that allows them to raise collectively up to $75 million per issuing entity, but to do so by releasing individual assets. For example, Michael Jordan rookie, right? PSA 10 could be $200,000. That's going to be presented to investors in a dedicated corporate structure so that investors could participate and buy $10 shares in that specific asset. You're able to do that through Regulation A. You're able to set up a platform, and this applies to NFT issuers too, right? 95 million or so NFTs, digital NFTs issued in 2020. What did that jump to? 24.9 billion, I think, in 2021. That's pretty significant.
Yep.
And we're all aware of the it's not even looming regulatory enforcement. I believe it's subpoenas now and the next level, right? So, and I believe thought leadership in this space, including at the legal community level from the securities attorneys, are advising clients that relying on the Howey test that is 80 years old is not apples to apples to what's going on with digital, I should say oranges to oranges, actually. What's going on in digital securities today. These are issuers who are looking to bring physical or digital assets. I call them securities. I'm not sure I'm right, but I that's my assumption that, because they feel like securities, right? Like they want to fractionalize, they want to sell them shares, they want to facilitate secondary market trading.
Promote a rate of return.
And they're making money somewhere along the way, right? Or someone is, right? So like, investors deserve protection. Like, yes, blockchain technology is ultimately, going to be, is critical. But I'm focused on what's actually going on today. I'm focused on the folks that are actually, fractionalizing, including NFTs, right? We have some of our issuers that are fractionalizing actual NFTs, like Bored Ape, whatever they're doing, whatever those are called, and selling them just like they're regular securities. And everything is pretty much digital anyway, right? So, but at the same time, I think we're seeing a lot of that, the community from the unregulated, decentralized side, that the last thing they want to hear is about a broker-dealer, right? But I see a transition amongst some of those digital asset or security issuers that want to do business in the US, starting to become advised by counsel that there's a cost-effective and a more conservative way to achieve your objectives. And their objectives typically are, again, to fractionalize, issue, and facilitate secondary market trading of digital securities, right? Of tokens.
Right.
And today, there's a way to do that in the US. Tomorrow, there may be a way to do that internationally and fully leverage the value and benefits of blockchain technology and tokenization. So that's kind of what we're seeing. We're seeing the guys the platforms that are actually doing it, in my opinion, the right way today, and really are models for building communities of folks that want access to these investment opportunities. whatever you want to call them, right? So that's what so we see that, and we see the secondary market trading industry evolving as well, right? There's a number of ATSs that are out there, and today issuers could choose to list their asset on an ATS. We've even seen an example of a company that's been able to co-list amongst two different ATSs.
Mm-hmm.
I think that's the direction that this industry is headed in, right?
I agree.
It's
100%.
because that's going to ultimately present the greatest potential for liquidity, which is in the best interest of the issuer and the public and the investors, right? Absolutely. It's not going to be limited to a walled garden per se, although it is available in a walled garden environment, and probably will continue to be so. But you see certain ATSs that are setting up platforms that are listing assets, and I think we're going to see co-listing, and I think ultimately with continued regulatory, decisioning, we're going to potentially see cross-jurisdictional liquidity
Agreed.
opportunities present themselves. And I think that's the holy grail that all of us are kind of waiting for, which is,
it is.
But it's going to be done so with protection for the investors, right? Like AML, you got to make sure terrorists aren't involved here. You got to make sure that these things you hear about with cryptocurrency, with money, hundreds of millions of dollars vanishing overnight, we can't allow for that. That's not going to work, right? So there needs to be a merging of regulation and technology, and Dalmore is looking to position itself as the front door for issuers looking to explore the options that they have to issue, primary and secondary wise, and to help facilitate. We've fortunately been able to achieve. We have over a 1 million Reg A investments since so far since 2019, and over the last, I believe, 6 months, we have over 100,000 secondary market trades for Reg A securities. So it's happening. This is going on now,
yep.
and there's a cost-effective and efficient path to get this done.
Yeah, and it's interesting because when you talk about the jurisdictions, you talk about we need the multiple liquidity pools available for getting maximum eyeballs and exposure on an asset. That the jurisdictional lines are getting thinner and thinner as well. We've had multiple discussions even in the past couple of weeks with other nations contemplating, well, how do I comply in the U.S., but I also want to be able to trade in LATAM, for example, a LATAM market. So, of course, folks like us, we're passionate, not necessarily about the offering and, the opportunity to, and, from an investment standpoint, but our focus is making sure that finance, legal, regulatory, all of those rails connect in a single spot so that asset truly is as easily movable like an Ethereum token from wallet A to wallet B, right? It's all the rest of the inefficient parts of the process, because as you've seen, there's already pre-IPO marketplaces that are out there trading on paper today, right? How give us a little insight into the current desk settlement process and the efficiencies or inefficiencies of just how at that intermediary layer, what's the workflow process look like from broker-dealer to broker-dealer?
So I could tell you that in my personal opinion, I'm not seeing any paper anymore. Mm-hmm. It almost feels like everything is already digitized from our perspective. In other words, you're able to fractionalize shares, through one of these exemptions. Again, you're able to sell these shares through IPO. You're able to integrate a transfer agent for real-time cap table management. And you're able to facilitate the secondary market trading of those, whatever you want to call them. And what's not digital about that? That is seamless. And the idea of, and my question is to you, what is the true value of tokenization? I guess it is, the ability to code the securities via smart contract with certain characteristics or certain rewards or perks that could be, or fan engagement. That's kind of what I'm seeing. But those could also be achieved, provided that the company is organized enough to follow through with with those obligations in that way. But we're past paper.
Yep.
We're even with traditional securities, forget about digital or tokenized. We're down to $10 shares that are efficiently able to be IPO'd and secondary market trading with brokerage statements. Like there's no paper exchange.
Yep.
So that's kind of what we're seeing. We're seeing the industry it's kind of already there from that perspective.
And that's great that the workflow and the automation is there within, each of those operation institutions. And I think that, to answer your question, why tokenize, right?
Yeah.
You're taking what is still a traditional piece of data that is replicated within each of those, enterprise operations, your workflow of your day-to-day, line of business application, and however you're working in the electronic, trading capacity. Because of the interchangeability of the data need, that is best achieved through a single source of truth, which is ostensibly what a blockchain is, right? Mathematical proof of a transaction, mathematical proof of a document or a piece of data. And so with each of those interoperable, current silos that are working on, their own internal electronic side, the data transmission is not necessarily the same, to say, hey, export, a bunch of Excel spreadsheet data from, part of your operation and part of your management application and send it to me. And then I'll figure out how to map my data to your data, right? The token and the smart contract really normalizes that, but it not only normalizes it from the brokerage standpoint, it normalizes that data between the custodians and the banks. It normalizes it between the regulators, right? Theoretically, it's as much a reg tech as it is a fintech application of the technology, and you're achieving those efficiencies by connecting those institutions. I mean, what is Bitcoin, right? It's a network, right?
Yeah.
The idea is that you've got this network of nodes that are operating as servers and exchanging common data and information. How do we now that extend that very basic just proof of transaction information, you sent me a Bitcoin on this day and time and, at this value or whatever, right? That's stamped to the chain. To do that in the securities world in an equal capacity gets a lot more complex because of all of those interoperating layers of activity that are required by licensing. At some point, will the function of the intermediary become, sort of sucked into the machine, and you have a blockchain broker-dealer, or a blockchain custodian? Does the blockchain become the custodian? We don't know. That's certainly above my pay grade from a policy and a legislative standpoint, but at least in terms of bringing efficiencies to the data, to the security, to the operations, the interoperability, in order to make good on passing data into from one institution to another in a seamless capacity, it's a marvelous advance. It's on par with the internet, right? The decentralization of information, right?
Yeah, no, that's fair, and I agree with you. I think that our model has been to work to reduce friction and create efficiencies via the current regulatory constructs. And because ultimately today, it's the SEC's approved transfer agent is the ultimate dictator of who owns what, as opposed to it being a blockchain. In the non-regulated world, the need to tokenize and to list on a blockchain were important for ease of transference, for accountability, but didn't necessarily have a regulated component to it. And I think as a result of that, maybe we saw some of the fraud or the misunderstandings that we've experienced with cryptocurrency and digital securities internationally over the last few years, and I think we're going to continue to see results of over the astronomical growth over the last year. So ultimately, we have a responsibility to make sure that the investors are protected and that there's a regulated entity that that has their hand on the neck of any other regulated entity that's tasked to oversee this, right? And I think that's ultimately what's most healthy to investors. So it's interesting, and it's an evolving space right now. So if you're an issuer today and you want to conduct business in the U.S., what's the right strategy? Like, how do you get started today? And how do you also kind of align yourself with hopefully what's to come? That's the question that a lot of these folks are asking, right? Because it's not as easy as avoiding KYC, AML, suitability, OFAC. You can't, that's not going to work right now. So it's not wallet to wallet, terrorist to terrorist. Sorry, it's not going to work. Get over that, okay? So now it's regulated. Now, what's the best you could do today to fractionalize, issue, and facilitate secondary market trading with as little friction as possible, while also positioning yourself with hopefully what's to come? That's the real question, and that's kind of what I guess both of us are kind of experiencing right now as these regulations continue to evolve and as more attention is put onto them and more thinking goes into them. And it's a pretty fascinating time to be doing what we're doing. So I expect the next months and years to really clarify a lot of this and hopefully unlock a lot of the efficiencies that exist currently with technology that's out there right now that's not being fully utilized, because it does take a while to penetrate the barrier of technology and historical regulatory regime, right? So
the technology tends to run way down the road past the regulators when it comes to the law. So interestingly, from the technology standpoint, we've been in a technology era now. I mean, electronic trading started in 1980, 1978, something like that. So here we are, full circle. And as we know, technology does have a tendency to disrupt, traditional intermediary layers. It's our view that really the big disruption is first going to come at the, outer end of the settlement and the clearing side, right? Because of just the nature of the technology. Why do you need a QSIP ID? You've got a blockchain transaction stamp, right? I mean, it's just there's some interesting dynamics starting to make its way into the conversation. But I think the bigger part of it, and this correlates over to banking, right?
Mm-hmm.
You're seeing the argument in the space right now. Hey, how do we create a digital form of fiat currency? We're going to use these magic bean tokens, right? And if tokenization of assets and securities is similar, then how do we make that same technology that's now digitally representing this other thing through provability of the legal construct, et cetera? But at what level does that also become so automated that it becomes a form of digital, once again, it's digital currency. I'm not just necessarily buying and selling a security for cash, but I'm using that security in, some other form of payment or asset swap, or, how does that take place? And, what is necessary in order to make that happen?
Yeah, that's a great question. And in fact, you see at least one ATS that I believe has been approved to accept digital cash in exchange for digital assets, right? As opposed to kind of how we operate, which is, you could invest in crypto, but you're not really investing in crypto. There's a cash register at the checkout process that converts the crypto into USD so that could go into escrow and to buy the securities, right? So the crossing that line, including crypto, digital to digital, that I think is super interesting, and I think is certainly an evolving space. And but it's also like, read the Wall Street Journal every day, and you'll get updated kind of on what's going on in that space. Meaning it's evolving, and I think it's going to probably take some time. And we're on the front lines of this. We're dealing with folks that want to issue assets, securities, assets, digital, whatever, and they want to also operate in the U.S. So there is a path today for that to occur. There's a primary issuance path. There's a secondary market trading path for digital securities. And we feel we're the leaders in that space because we're so focused on Reg A, which happens to be a really interesting exemption to consider for folks that want to achieve that as close to that, objective as possible in the current regulatory construct, right?
Yep.
And we're also working with others in the space to prepare for that, that co-listing amongst multiple ATSs, which is stage 2, and then for blockchain, activation for the cross-jurisdictional trade liquidity that might present itself at stage 3. But we're really in the weeds of if you're an issuer today and you want to take your strategy to market, primary and secondary, here's 25 platforms that are doing it right,
Yep.
that are doing it in a regulated way based on today. But we're super interested in always observing and learning more about how to improve efficiencies. And I think we're gonna see a lot of that over the upcoming months and years for sure.
So we have an open question here. If you guys are interested in throwing some specific questions into the mix, we'll definitely seek to answer them. You can throw them either in the webinar chat or in the Q&A specifically. We can answer both of them. But it's actually an interesting question to consider given where the market's at. Retail consumers already pay zero commissions on equity trades. So what is the benefit from tokenization in terms of economics to them?
I think the idea is that you're reducing the manual labor and work from the regulated entity to justify and warrant a fee for that service ultimately. So part of this technological advancement and is intended to create efficiencies, which is going to reduce historical costs of things that were more manual in nature. So you're going to see, hopefully, commissions go down. You're going to see compliance more condensed and perhaps easier to track and perform and oversee, because there's always going to be that human element, right? If you have compliance involved, there always has to be humans that check to make sure things are done properly. Maybe one day that'll be eliminated completely, but I don't really see it. I see that final check as being super important, and there's a cost in that. But I think you're going to see a reduction in commission as a result of that, and of third-party fees, of third-party transactional fees, and payment rail fees, and markups. Which I think is super healthy to the industry as a whole, and to issuers and to investors, right? They're the ones that should benefit from that savings, not the intermediaries like us, right? In that way. Right. So I think that's where it's heading.
Yeah, I agree with you. I mean, if you just look on the technology side of the fence, right? What was Jeff Bezos's famous comment, like your margin is my opportunity, and the Amazonification of everything, right? It's like the automation of back office processes. Can we make it so inexpensive? It's reducing the cost to, ever approaching zero. And I think that's also an interesting aspect of the compression of the back office logistics and the operations, particularly in compliance. I mean, you really are talking about massive disruption in how intermediaries view compliance, right? Why can't a institution that does the KYC, that's a reporting institution for a new account, what makes that better or different than forcing another KYC process at another institution? At what point do the chief compliance officers get their heads together and say, you know what, there's this whole layer of data of redundancy and cost, operating expenses, how do we make compliance
Yeah.
data interchangeable?
There's other elements of compliance. First of all, there's reviewing advertising and promotional materials that these issuers are using. Right. There's bad actor checks and due diligence on the company to make sure that certain things are checked before they're ready for prime time. So I don't know if we're going to get away from the human element involved, the common sense component. I don't think it's going to be completely as free as the one may like to see because you got to look out for the investors, and that requires intelligence. It requires a regulated entity that is subject to being regulated and audited to perform certain tasks that might continue to evolve based on where the market environment is at any given moment, and to implement and maintain best practice. And so I think that there's always going to be a need for a regulation and a regulated. I think that's super healthy, but I think that the cost structure could go down tremendously. I mean, look at our issuers. Look at our, on average, they're paying 1%, right, for primary issuance to us for playing this very important role, right? So they're able to issue NFTs, Michael Jordan rookies, racehorses, art, media rights, whatever you want. You're able to, that 25 billion of NFTs were issued, that could all be done through Regulation A in a pretty cost-effective way, right? And we have some Reg A issuers that have 3 issuing entities going on at the same time, right? And so, that's kind of what we're seeing. But as far as efficiencies, as far as reducing friction and reducing cost, for sure, that's what technology is there for. There just needs to be buy-in at the top level, and we need to all feel comfortable. I think that wherever we end up, it's in the best interest of the investors.
Yep,
that's the bottom line to me. From my perspective, you want to have a stable and a predictable capital markets environment, and as an investor, you're not necessarily always reading the fine print. You want to know that the regulators are taking care of that to some degree. And I think that's super healthy for the industry to have a kind of a gatekeeper to an extent. The question is how you merge that with technology and keep up with technology. And that's what the regulators are tasked to kind of explore and understand today. And that's why it sounds so simple. That's right. And that's why these are all very on. They're on. It's technology meets innovation meets regulation.
That's right.
And it's not orange orchards anymore. It is
100%.
very different, very, very different. And it's not the easiest thing to navigate. And there's a lot of competing interests as well. There's a lot of very big investment banks and broker-dealers that make a lot of money doing what they do. And they don't necessarily have an interest in giving that up, right? Or reducing their role in this process, right? They like friction. Our model's been, to be on the side of friction reduction, recognizing there's a need for a regulated entity, but looking at it more from the perspective of the capital markets and how do we become a participant, an enabler for companies to do things the right way in a really cost-effective way.
Yep.
And I think that's why we've onboarded over 200 Reg A issuers, right? Is because our model is, why do you need a broker-dealer? And how do we play that role for you in with as little friction as possible, as cost-effective as possible, and as experienced as possible to really enable you to achieve your issuing and secondary market trading objectives.
Yep, agreed. So we got a couple of other questions that posted to the chat. Do any of the top 100 tokens on CoinMarketCap use an SEC pathway to compliant trading in the U.S.? If it's a token that's listed and trading on a cryptocurrency exchange and a digital asset, then by nature it would have to be compliantly listed with a compliant money services business. All of the crypto exchanges that are not securities exchanges in the U.S., they fall under the money services or money transmitter regime, and that's at the state level. So like Coinbase, for example, they are licensed as a money services business in all 50 states and territories, 52 territories. So there is a distinction between the SEC having purview over that, which is a security, and of course there's some high profile cases going on right now where there's some even top level digital asset cryptocurrencies. The Ripple case, for example, is a big one, in trying to exercise jurisdictional claim and control over that particular offering and network, and so it is tip of spear right now for just the cryptocurrency side of the fence. But the exchanges, the cryptocurrency exchanges in the United States have been very quick to delist and cease trading of any of those assets that have been questioned by the SEC, because of course they don't want to be implicated in some form of transacting, trading a security without a exchange license or an ATS license. So once again, though, that's the crypto world versus what we're talking about, which is very much applying the same technology, but starting with the fact that it is a security, and we're just simply using that token as a unit of account, and then bolting on all the necessary data and the workflows and the approvals and the compliance and governance to all of that security with the technology. But we start with the premise that it is 100% a security out of the gate, versus crypto, which started with the tech, and then it may or may not be a security, right? Depending on the judge, I guess, at this juncture. So a couple of other comments or questions. Is securitization the same as tokenization? Well, I would argue no, because you can securitize something without tokenizing it. So tokenization is where you're actually creating a programmable form of the security itself, but securitization is more of a legal construct, a notional legal construct, as opposed to a technology construct. They can work hand in hand. You're using the token as a unit of account, programmable form of representation of what otherwise exists in legal documents. Right? So and then we got another one here real quick. Pull this up so I can see the whole question. This is Obi from SQF Coin. Equities markets can adopt blockchain, but crypto markets will not. In crypto, there will be only the primary market. Nature of Web 3.0 and the democratization of investment and wealth seems to be dictating that. So that was more of a statement than a question. But that's interesting, the bifurcation of the really the philosophical construct of the hardcore crypto folks. And we don't care about government. We don't care about regulation. We're going to create this parallel financial system versus the regulatory rails, right?
Mm-hmm.
How often are you getting phone calls from NFT guys that are like, "Uh-oh, we're in trouble"?
It's starting to happen. And there's been a lot of alarms and bells that have been rung over the last few years by folks in the industry. That's a big jump, 95 million to 25 billion in 1 year. And we're the ones that are fortunate to have 25 or so clients that are doing this, I think the right way, right? And it's cost effective. Again, you want to sell fractionalized assets digitally to U.S. investors. You want to facilitate secondary market trading of those assets or securities. Look into Regulation A. Get qualified. It doesn't have to be an intimidating thing. Yes, you're not going to be able to put these securities in your own wallet and just send it to whoever you want in the world, but there's a reason why, right? There's a reason why, because you want to make sure that you're protecting investors, that you're not helping to facilitate any, unethical activities, right? So regulation is an important component in partnering with to unlock this technological potential. From my perspective, it needs to come with safety. It needs to come with ethics. It needs to come with accountability and transparency. That's what it's all about, anyway, right? Yep. It's all about the transparency and openness and reducing. We could reduce fees We could implement technology that's going to be super beneficial to the issuers and to the investors, but we're never going to be able to strip away the fact that there needs to be someone that's overseeing this, to looking out for the best interests of investors who are trusting what people are saying about them, making sure that what they're saying is not promissory or exaggerated or fraudulent, right? From an SEC anti-fraud provision level. These are important. It is. And that's why these regulations exist today.
Absolutely.
So we're going to get there. We're going to keep reducing friction. And a lot of the friction is already reduced. Look at our website under fractional share issuers. You're going to see 20 some odd companies download their apps. Look at what they're doing. This is possible. This is going on today. Primary issuance, secondary market trading, $10 shares, $5 shares, real estate, collectibles, athlete contracts, revenue streams. It's already being done. It is already being done. And we get calls every day by folks that have the next great idea of what they want to do. But to do so in the US without doing so in partnership with a regulated entity, I think is not the side of history you want to be on today.
Yep.
It's not.
I agree.
You know, and that's why I think we're at such an interesting time right now. Because yes, Michael, to answer your question, we are getting calls by folks saying, we already issued this, and this. What do we do? I'm like, talk to legal counsel. Talk to, you know, there's a path for you. We're not lawyers, but, you know, talk with your legal counsel about what you do with what's been done already. But as far as going forward, in approximately 4 months from now, you could have SEC qualification, you know, provided there's no bad actors, provided you make it through, you know, your 1A is qualified by the SEC and FINRA issues a no objection letter, which they have to do for all of our Reg A clients. There's a path for you to do very similar things to what your ambitions are. You're not going to have the same level of transference globally. Sorry, it doesn't exist today if you want to do business in the US. Hopefully it will soon. You know, today you have an ATS, maybe co-listing on another ATS, and maybe hopefully in the future co-listing on across different international jurisdictions. That's what we're all working for. The technology is already there. It's just a regulation has to happen, right? And so you want to work with a company that's able to get you up and going now, but also positioning you for what's to come. And I think 10XTS is a great example of an advisor that's thinking from that perspective, that's up to date on what's going on the regulatory levels. That any issuer who's going through this predicament right now, I personally think you guys are a great call to have, to hear your perspective, to showcase what it is, the work that you've done, you know, already, and that you're providing to others in this space that are going through it. And hopefully we're a good resource as well.
Absolutely, 100%. Great partnership. So, all right, guys. Well, I appreciate everybody attending today. I know there were a couple of other questions, but we're going to try to bring this one to close to give everybody a chance to get back to the work grind sooner as opposed to later. I appreciate everybody attending. Tan, how do we get a hold of you?
Google.
He's pretty easy to find. Same with me.
Dalmore Group. DalmoreFG.com, DalmoreGroup.com, Dalmore, although it's a Scotch, so you probably want to put Dalmore Group if you're Googling it. A pretty good Scotch, actually. And so, but yeah, Dalmore Group, and you'll be able to find us online and LinkedIn and all that. And we look forward to hopefully speaking with you soon.
Absolutely. And of course, we're at 10XTS, 10XTS.com. And, please take us up on the offer to join the Digital Securities Lab. It's dslab.co, but we will be sending a VIP invite to everybody that registered on this webinar, and look forward to the continuation of the industry discussion, because it's going to take a whole lot of smart people working together to make all of this global impact ultimately materialize. So with that, sir, I appreciate the time, as always, with you today, and looking forward to hanging out in Miami. We'll hang out on Collins Avenue and go get some Miami Beach fun. And
let's do it.
Look forward to chatting with you again super soon. I appreciate it. Thank you.
Thank you, brother.
Thanks, everybody, for attending.